All right, the market's at a critical inflection point. What follows is a tactical framework for positioning over the next 1 to 2 weeks.
Okay, let's get right to it. The central conflict here is pretty stark. You've got record systemic leverage on par with the 2000 and 2007 peaks, fighting against major technical support levels that are, for now, holding firm. This is what's creating this high-stakes stalemate.
And this number right here, 41.4%, really drives home the concentration risk we're all looking at. That is the S&P 500 weight of just the top 10 stocks. Think about that. This narrow leadership means the entire market's fate is basically resting on a handful of megacaps. Historically, concentration this high has come before some pretty significant market volatility. If these leaders falter, the broader index has a long way to fall.
So here's how we're going to break this down. First, the market at a brink. Then we'll hit the bear case, followed by the bull case. After that, we'll pinpoint the key levels on the chart, run through scenarios and our strategic posture, and then wrap up with a couple of risk-defined option setups.
First up, Section 1, the market at a brink. Right now, we're just seeing these powerful forces pulling in opposite directions. It's creating a lot of indecision and a ton of two-way volatility. So what this slide really gets at is a critical disconnect. On the surface, what do we see? The big mega caps are holding up the major indices. But what don't we see? Well, if you look underneath, market internals like the advanced decline line, they're deteriorating and fast. That kind of divergence, it rarely lasts. Now for Section 2, the bear case. Let's dig into the cracks that are starting to show up in the system.
All right, let's walk through the primary bearish factors here. First, record NYSE margin debt. That means a higher risk of forced selling if things turn south. Then you've got a prolonged U.S. government shutdown that's delaying key economic data, making it hard to get a clear read on anything. We've also got that deteriorating breadth I mentioned. The S&P advanced decline line is diverging negatively. And finally, volatility is clearly on the rise. October saw a big increase in 1% daily moves.
And this quote, it really gets to the heart of the mechanical risk here. If we break that key support, it's not just a line on a chart. It could trigger a cascade. When the market drops below a level with a ton of put options, the dealers who sold them are forced to sell stock to hedge, which just pushes the market down even faster. That's your negative gamma risk in a nutshell. But hey, there is a counter-argument. Let's pivot to Section 3, the bull case. And this one is really built on pockets of hidden strength.
The bullish catalysts are also pretty significant. First, you've got a liquidity backstop from China's central bank. The PBOC has initiated QE. Second, there was a massive institutional buy, a record phantom dark pool print at the QQQ 600 level. That suggests the big money is stepping in. And third, some of the most beaten-down sectors, like small-cap growth and biotech, are showing signs of life, forming potential long-term bases. That could mean the rally is about to get a whole lot broader.
Okay, so all this conflict, it really boils down to a few critical levels on the chart. So in Section 4, we're going to look at the lines that matter the most right now.
For the S&P 500, the absolute line in the sand is 6750. This is a major support level, based on both the chart and where a ton of options are sitting. It's a must-hold for the bulls, period.
Now for the NASDAQ 100, looking at the QQQ ETF. That critical level is 600. This is a confluence point. You've got the 50-day moving average and that huge institutional buy order lining right up. If this level breaks, a big piece of the bull case just falls apart. And finally, let's check in on Bitcoin as a barometer for risk appetite. That $95,000 to $100,000 zone, that is the key support area to watch. If we see a decisive break below 95K, that would likely signal a major risk-off move across all markets. Okay, let's move to Section 5 and translate all this analysis into an actionable framework. Here are the main scenarios and the strategic posture for each one.
All right, before we get into the scenarios, just a quick but important disclaimer. This content is for educational purposes only. It's an aggregation of public sources to help you stay informed. This is not financial advice, so please do your own research.
Okay, our base case is more volatile chop, sideways action, as long as the S&P holds 6750. The posture here? Stay patient. Hold 30–40% cash, keep hedges on. The bull case really kicks in if QQQ successfully defends that 600 level. That's your signal to add delta on confirmation. The bear case gets triggered if SPY breaks 6750 decisively. If that happens, it's time to move to a net short delta posture. So to put it simply, the bull thesis relies on PBOC liquidity flooring the market, while institutions absorb shares at support and the rally broadens out.
The primary risk is SPY 6750 failing. On the other side, the bear thesis hinges on that record leverage unwinding once SPY 6750 breaks, triggering negative gamma, with a Bitcoin break below 95K confirming a major risk-off event.
All right, finally, Section 6. Here are two specific risk-defined option setups that align with the market structure and the key levels we've just talked about.
First setup is a play on that key support in QQQ. It's focused on defending that critical 600 level. So the structure is a put credit spread. You're selling the 600 put and buying the 590 put for protection, looking out 2 to 4 weeks. The rationale is to exploit the high confidence in that 600 support level and collect the premium. The trade is invalidated on a sustained close below 600. This is a starter position only.
Okay, the second setup is a bit more speculative. It's a breakout play on small cap growth, which would be a very healthy signal that the market rally is broadening.
Here, the structure is a call-debit spread on IWO with a 1 to 2 month horizon. This gives you a risk-defined way to position for a high beta catch-up rally if the market resolves higher. The invalidation point? A false breakout and a reversal right back into the base. Again, this is a starter position. You can consider adding on confirmation above the breakout.
Now, a necessary word of caution. Options are complex instruments. Capital is at risk, and on certain strategies, losses can exceed the premium you paid. You absolutely must use disciplined sizing and have stop losses in place.
And to wrap it all up, the final disclaimer. This is not trading advice. This is just a market update to keep you informed. All markets carry risk, so trade your plan, manage your downside, and always verify all the data for yourself.
And that leaves us with the one critical question for the weeks ahead. With record leverage fighting central bank liquidity at these exact levels, which force is going to break first?